Did you know that nearly 60% of college students say they wish they had learned more about money before graduating? 60%. That means more than half of people just like you are walking out of college feeling unprepared for one of the most important parts of adult life, managing their finances. Today, we are going to fix that. By the end of this video, you will understand the 5 essential pillars of financial literacy that every college student needs to know. We are talking about budgeting, credit, debt, saving, and smart spending. No confusing jargon. No boring lectures. Just real, practical knowledge you can actually use starting today. Let's get into it. Section 1. What is financial literacy and why does it matter? Financial literacy simply means understanding how money works, how to earn it, manage it, grow it, and protect it. It sounds basic, but here is the thing most people do not realize. Financial skills are not something you automatically pick up just by growing up. They have to be learned, and unfortunately, most schools do not teach them. College is actually the perfect time to build these skills, because the financial decisions you make right now can follow you for decades. We are talking about student loans, credit cards, rent, groceries, and everything in between. The students who take time to understand money during college are far more likely to feel financially confident after graduation. Think of financial literacy like a GPS for your life. Without it, you might still get somewhere, but you will probably take a lot of wrong turns and waste a lot of time and money along the way. And here is something worth thinking about. If budgeting is the foundation of all financial literacy, what does a budget actually look like for a real college student? We will break that down right now. Section 2. Budgeting. Knowing where your money goes. A budget is simply a plan for your money. It tells every dollar where to go before the month starts, instead of wondering where it went after the month ends. Here is a simple framework that works really well for college students. It is called the 50-30-20 rule. 50% of your income goes to needs, things like rent, food, transportation, and tuition costs. 30% goes to wants, eating out, entertainment, subscriptions, and 20% goes to savings or paying down debt. Now, when you are in college and maybe working part-time or living off financial aid, you might need to adjust those percentages. The point is not the exact numbers. The point is being intentional. You have to know what is coming in and what is going out. There are free apps like Mint or YNAB that can make this process really simple. You link your accounts, set categories, and the app tracks everything automatically. The biggest mistake college students make with budgeting is waiting until they are broke to start one. Do not wait for a crisis. Start now, even if you only have a small amount of money to manage. Building the habit early is what matters most. So budgeting helps you manage what you have right now. But what about building a financial reputation for the future? That leads us to credit. Section 3. Credit. Your financial reputation. Your credit score is basically a grade that tells lenders how responsible you are with money. It ranges from 300 to 850, and a higher number means better credit. This number affects whether you can rent an apartment, get a car loan, or even sometimes whether you get hired for certain jobs. Here is the part most students do not know. You can start building credit right now in college, and it is actually a huge advantage to start early. The safest way to do it is with a secured credit card or a student credit card. These cards have low limits, which helps you stay out of trouble. The golden rule is simple. Only charge what you can pay off in full every single month. That way, you get the credit-building benefits without paying interest. Your credit score is calculated based on a few key factors. The biggest one is payment history. Just paying your bills on time, every time, is the single most powerful thing you can do for your credit. The second factor is credit utilization, which means how much of your available credit you are actually using. Try to keep that below 30%. Good credit takes time to build, but can be destroyed very quickly. One missed payment can drop your score significantly. Treat your credit card like a debit card. Only spend what you already have in the bank. Now that you understand credit, you might be wondering about the flip side. What about debt? Because for most college students, debt is already a reality. Section 4. Understanding debt, especially student loans. Let's talk about the elephant in the room. Student loan debt in the United States has passed $1.7 trillion. For many students, taking on some debt to afford college is unavoidable. But there is a big difference between informed debt and uninformed debt. First, understand the difference between federal loans and private loans. Federal loans come from the government and typically offer lower interest rates, flexible repayment options, and protections like income-driven repayment plans. Private loans come from banks or lenders and often have fewer protections and higher rates. When you borrow money for college, you need to understand 4 things: how much you are borrowing total, what the interest rate is, when repayment begins, and what your monthly payment will look like after graduation. A helpful rule of thumb is to try not to borrow more in total student loans than you expect to earn in your first year of work after graduation. This keeps your debt manageable. And remember, credit card debt is a completely different beast. Credit cards carry much higher interest rates, sometimes over 20%. Carrying a balance month to month can spiral out of control fast. Pay it off every month. No exceptions if you can help it. Understanding debt is important, but so is building wealth over time. That is where saving and investing come in. Section 5. Saving and smart spending. Building your future. Saving money while you are in college might feel impossible, but even saving $10 or $20 a month builds an incredibly important habit and creates an emergency fund over time. An emergency fund is money set aside specifically for unexpected expenses: a car repair, a medical bill, a broken laptop. Financial experts recommend eventually having 3 to 6 months of expenses saved, but starting with even $500 gives you a safety cushion. Smart spending goes hand in hand with saving. Before every purchase, ask yourself 3 questions. Do I need this? Can I afford this right now? Is there a cheaper alternative? Taking advantage of student discounts, buying used textbooks, cooking meals instead of eating out, and sharing streaming subscriptions are all small decisions that add up to hundreds of dollars saved every year. The mindset shift here is powerful. You are not depriving yourself, you are choosing your future self over your current impulse. So there you have it. Financial literacy is not complicated, but it does require intention. You learned about why financial literacy matters, how to build a budget that actually works, how to start building credit responsibly, how to understand and manage debt, and how saving and smart spending set you up for real success. Here is your challenge this week. Open a free budgeting app and track your spending for just 7 days. No changes yet, just awareness. That single step can completely change how you think about money. If this video helped you, please give it a like and subscribe so you do not miss the next one. And drop a comment below. What is the one money topic you wish someone had explained to you sooner? I read every comment, and I might just make a video answering your question directly. Thanks for watching. Now go take control of your finances.